I made my first million at 40 and my first billion at 75. People always ask me what changed. Was it luck, a magic investment, some hidden shortcut? No, the truth is far less glamorous. I simply stopped doing stupid things. Everyone is out there hunting for the secret to wealth, as if there's a mystical formula locked away in some vault. They chase miracle stocks, perfect market timing, mystical forecasts, insider whispers. But there is no secret. There is only a long, boring, brutally effective list of dumb mistakes and the discipline to avoid them. That's it. If you dodge the idiocies that everyone else embraces, you win by default. I've spent 6 decades watching brilliant people sabotage themselves. CEOs, founders, traders, geniuses. Same disasters, same blind spots, same ego traps. And I see many of you doing those exact things today. These 7 mistakes won't just set you back a little. They will steal decades from your life. Not months, not years, decades. Most people don't understand this until they hit 60, broke, bitter, and convinced the world cheated them. So before you become one of them, I'm handing you the checklist. If you're guilty of even 3 of these mistakes, congratulations, you're already 10 years behind where you should be. Let's find out which ones are dragging you down. This is the Munger method. No hype, no horoscopes, no fantasies about getting rich quick. Just the principles that keep working long after every trendy strategy crashes and burns. Let's begin.
Mistake number 1. You insist on learning from your own mistakes instead of everyone else's. This is the wrong approach. Completely backward. I am not nearly smart enough to personally experience every mistake a human being can make, and neither are you. You don't have the lifespan for that kind of stupidity. So, I read, and not the feel-good self-help fluff people addict themselves to. I study failure, catastrophe, collapse. Every stock market crash, every corporate implosion, every historic fraud, if someone ruined their life doing it, I've read the autopsy report. Why? Because the same patterns repeat endlessly, the same warnings ignored, the same greed, fear, and delusion dressed up in new clothing. Everyone thinks they're the exception. Everyone believes that when the next bubble inflates, they'll be the genius who sells at the top. No, you won't, unless you've studied the lives of the people who held the exact same belief and got obliterated. The South Sea bubble happened in 1720, 3 centuries ago, yet humans fall for the same scam every decade. Change the packaging, swap the buzzwords, and people line up to lose everything. Tulip mania, railroad mania, .com euphoria, housing insanity, crypto fever. The script never changes. Mass delusion followed by mass regret. Every bubble begins with the phrase, "This time is different," and ends by proving it never is. I studied the Great Depression even though I wasn't alive to witness a single moment of it. But I sure as hell learned from the people who borrowed money to buy stocks and got wiped out by margin calls. thousands went from wealthy to ruined in days. What did that teach me? Simple. Never use leverage. Ever. If you can't afford to own an asset outright, you have no business touching it. Leverage is how people turn temporary setbacks into lifelong tragedies. And that's just mistake number 1. I read every biography I could get my hands on, not for motivation, not for inspirational quotes, but to build a library of human stupidity. Carnegie made blunders. Rockefeller made blunders. Even Ben Franklin, the man practically canonized for wisdom, fell for a ridiculous investment scheme that blew up in his face. But here's the thing. They wrote it all down. They documented their failures so the next generation wouldn't have to repeat them. All I had to do was pay attention.
But what do most people do instead? They lose money in crypto and act stunned, as if they're the first pioneers to be speared by a get-rich-quick fantasy. They buy a stock at the very top of the mania, watch it plunge, and stare at the screen like it's some cosmic injustice. But it already happened in 2000, and 2008, and 1987, and 1929. The warnings were there. The history was there. Entire shelves of books, documentaries, lectures, case studies. But you didn't read any of them because you were too busy watching videos titled Top 10 Stocks to Buy Now Before They Explode. Here's the truth about learning from other people's mistakes. It's not just cheaper, it's faster. I compressed 3 centuries of market disasters into a few years of reading. I learned what wiped out investors in the 1800s, the 1900s, and every shiny decade since. I didn't have to live through each disaster myself. I didn't have to donate my life savings to every bubble. I just had to study the people who already did. So here's your assignment. Simple, powerful, life-changing. Read 1 financial disaster case study per month. Just 1. That single habit will save you hundreds of thousands of dollars over a lifetime. Start with the dot-com bubble. Read about Pets.com and Webvan, companies that burned billions and ended with nothing but a tombstone and a punchline. Study the 2008 meltdown. Look at Lehman Brothers and Bear Stearns. Ask, how did giants fall? What were the early warning signs? Who ignored them and why? Then read about long-term capital management, a hedge fund run by Nobel Prize winners, literal geniuses, who built a mathematical model that predicted their strategy would only fail once every 1,000 years. Spoiler, they were wiped out in 4. How? Why? Find out. Learn the anatomy of Enron. Not just they committed fraud, but how they created the illusion of profit, how they hid debt, how brilliant auditors missed the rot, how analysts kept rating them buy, even as the company quietly rotted from the inside. Read about Tesla short sellers who lost billions betting against Elon Musk. What assumptions were wrong? What did they underestimate? Study Bill Ackman burning $4 billion on Valiant Pharmaceuticals and walking away with 0 cents. What blind spot took him down? Each of these stories is a tuition bill someone else paid. You can either learn from them or write your own tragedy. Boring? Maybe. But losing your entire portfolio is a much more boring experience. Trust me. Mistake number 2. You're buying things you don't understand. This one drives me absolutely insane. I operate with one rule. Simple, brutal, uncompromising. If I don't understand it, I don't buy it. No negotiations, no exceptions, no someday I'll figure it out. End of story. It sounds obvious, right? Then explain this. Why did you buy crypto in 2021? Can you explain how blockchain actually works? Can you explain mining? Can you explain proof of work versus proof of stake? Can you explain what gives Bitcoin value beyond wishful thinking? No? Then you weren't investing. You were gambling, and now you're angry that the casino didn't pay you. Here's what kills me. You spend an hour researching a $50 toaster on Amazon. You'll read reviews, compare features, debate whether it needs a bagel setting or a crumb tray. But when it comes to putting $5,000, $15,000, or $50,000 into an investment, you spend less time thinking about it than you spend choosing lunch. But you'll happily toss $10,000 into a stock because some anonymous teenager on Reddit typed "diamond hands to the moon" and added a rocket emoji, as if that emoji somehow guarantees returns. Brilliant strategy. Truly airtight. Might as well invest based on a horoscope. Meanwhile, I've passed on thousands of investments. Massive future winners. Companies that went up 50x, 100x, even more. And I slept like a baby. Why? Because I didn't understand them. And here's the rule I'd carve into stone. I'd rather miss a winner than lose a single dollar on something I don't truly understand. That's the trade. That's the discipline. That's how you survive long enough to get rich. I skipped tech stocks in the 90s because I didn't grasp them deeply enough. People lined up to tell me I was washed up. You don't understand the internet, old man. Maybe I didn't, but I also didn't lose a penny when the dot-com boom turned into the dot-com funeral. I passed on Amazon in the early days, too. It didn't make sense to me at the time. Bezos was lighting money on fire every quarter, losses everywhere, and somehow the world was calling him a visionary. I couldn't reconcile the story with the numbers. Did it cost me? Sure. Amazon skyrocketed over 100,000%. Oops. But did I lose money? Not a dime. And that's the point of rational investing. You don't have to catch every rocket if you avoid every landmine. Most people don't get this. When you only invest in things you clearly, deeply, fundamentally understand, you remove 90% of the ways people blow themselves up. You'll miss some spectacular winners, but you'll never be the guy losing his retirement to a fraud, or a bubble, or a shiny product that collapses the moment someone asks a real question. I never bought Enron, never touched WorldCom, never went near mortgage-backed securities before 2008. Why? Because either I didn't understand them, or I did understand them and realized they were ticking bombs wrapped in glossy marketing. Either way, I kept my money, while brilliant people, PhDs, hedge fund veterans, analysts with 30-page models, lost billions on things they thought they understood, but didn't. That's what greed does. That's what complexity does. People want to look sophisticated, so they buy exotic derivatives and leveraged instruments with names so complicated you need a dictionary to pronounce them. Then they act shocked when the entire structure collapses. Here's the ultimate test I wish investors tattooed on their foreheads. Can you explain your investment to a 10-year-old? Watch this. I own part of a company that sells soda. People like soda. They buy it every day. The company makes money and gives me some of the money. That's Coca-Cola. Simple, understandable, predictable. A business that's been selling sugar water since 1886 and still spitting out cash like a printing press. Now try explaining this to a kid. A synthetically leveraged derivative tied to projected volatility based on hypothetical future liquidity in a decentralized blockchain ecosystem. See the problem? If you can't explain it simply, it's not because it's smart, it's because you don't actually understand it. I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms to yield farm governance tokens in a decentralized autonomous organization. Read that sentence again. What the hell does that even mean? It sounds like someone dumped a finance dictionary into a blender and hit puree.
If your investment requires 15 minutes, a whiteboard, 3 diagrams, and a TED Talk just to explain the basics, let me break something to you. You don't understand it. You're not analyzing. You're not evaluating. You're parroting buzzwords you heard on YouTube from a guy whose entire net worth is a gaming chair. And here's a far more important test, one that 99% of investors fail. Can you explain how it actually makes money? Not why the price might go up, not why the community is strong, not why it's early or revolutionary. No, how? Where does the cash come from? What value does it create? Who pays for that value? If you can't answer that question in one clean, simple sentence, you're not investing. You're gambling with adjectives. You're hoping some bigger fool buys it from you later at a higher price. That's not a strategy. That's just musical chairs with better graphics. So do this right now. List every investment you own. Every stock, every fund, every crypto token, every shiny thing in your portfolio. Now ask a single question. How does this generate real money? If your answer starts with, well, theoretically, or in the future, or if adoption, stop. Sell it. Today. Not next week. Today. Because you're about to learn the most expensive lesson of your life, and I'm trying to save you the tuition bill. Mistake number 3. You're in a hurry. This one destroys more wealth than recessions, taxes, and bad luck combined. You want to get rich by Thursday. You want financial freedom before the weekend.
You want the magical shortcut the gurus on Instagram swear exists if you buy their course. Let me tell you something uncomfortable. It doesn't exist. Never has. Never will. I made my first million at 40. My first billion at 75. Between those milestones, 60 years of discipline. Not 6 months, not 6 years. 60. People ask me all the time, what's the secret to getting rich fast? The secret is that there is no fast. Just time, patience, and the quiet miracle of compound interest.
The big money isn't in the buying. It isn't in the selling. It isn't in timing the market, predicting the market, or calling the next Amazon. It's in the sitting, the waiting, the doing absolutely nothing while the impatient burn themselves alive. But you can't sit still. Doing nothing feels like losing. You see some stranger online make 200% on a meme stock in 3 weeks, and suddenly you're in full panic. Everyone's getting rich except me. I need to do something. And then the madness begins. You trade, day trade, swing trade, options, crypto, leverage, hot tips from Twitter threads written by people who can't spell volatility. 5 years later, you've made zero progress. Actually, worse than zero, because you've paid fees, taxes, and stress. Meanwhile, the boring guy, the guy who bought an index fund 5 years ago and literally forgot it existed, he's up 60, 70, 80%. He doubled his money by accident. He sleeps like a baby. He's not checking his phone every 5 minutes. He's not having panic attacks when the market dips 2%. He's not arguing with strangers at midnight about why some penny stock is undervalued. Here's the math you don't want to believe. 20% a year isn't sexy. It isn't cinematic. It won't impress anyone at a party. But 20% a year for 60 years turns $10,000 into $500 million. That's the 8th wonder of the world, compound interest. Not flashy, not dramatic, but undefeated.
You, on the other hand, want to be a millionaire by 30. So you take stupid risks. You use leverage. You buy speculative trash with big promises and zero cash flow. Maybe you win once, maybe twice. Then you lose it all, because the game always comes back to collect. What you actually need isn't brilliance. It isn't risk. It's consistency. Hit singles. Get on base. Avoid strikeouts. Don't swing at pitches designed to humiliate you. That's the whole game. But your ego hates that game. Your ego wants fireworks. Your ego wants to brag. You brag about making 500% this year. You want that dopamine hit, the screenshot of your portfolio exploding in green and the flood of comments telling you you're a genius. You want to walk into a party and casually drop, "Yeah, I crushed the market this year," like you're some kind of Wall Street prodigy. What you don't want to say is the truth, that real wealth comes from decades of slow, boring compounding in companies so unexciting that no one would even pretend to care if you mentioned them. Nobody applauds patience. Nobody cheers for discipline.
But that's exactly what works. And the flashy approach you love so much, it fails. Consistently. Here's the reality you've been avoiding like the dentist. The mistake number 4. If you've been investing for 5 years and you still can't beat something as simple as the S&P 500, a fund that just sits there, yawning, doing absolutely nothing, then you're not an investor. You're a gambler with a losing streak so long you've stopped noticing it. The S&P averages around 10% a year over the long haul. No hype, no secret Discord groups, no late-night chart analysis, no guru live streams wearing sunglasses indoors. Just steady, consistent returns. And if, after all your emotional roller coasters, sleepless nights, frantic trades, and endless subscriptions to expert stock-picking newsletters, you're still lagging behind a mindless index fund, congratulations! A robot charging you $3 a year is outperforming you by doing literally nothing. The guy who bought an index fund 5 years ago and forgot the password to his brokerage account is beating you while watering his plants.
And here's the part that hurts, but you need to hear it. More than 90% of active traders don't beat the index over a decade. 90%. These aren't random amateurs. We're talking professionals, people with teams, algorithms, resources, degrees. They still lose. And you think you're the magical exception? You're not. You're playing in a casino that rigs the odds against you, cheering every tiny win while ignoring the avalanche that follows. Now let's talk diversification, the word Wall Street loves to use to sell you more products. You've been told to spread your risk, to own dozens of stocks, international funds, bonds, commodities, crypto, gold, silver, a little bit of everything so you feel safe. And sure, it sounds wise, but in reality, when you own everything, you owe nothing. You've basically rebuilt an index fund, except yours is messier, more expensive, more complicated, and somehow performs worse. Here's what Munger actually meant. Diversification is protection against ignorance, which is a polite way of saying, if you don't know what you're doing, diversification is your crutch. People who truly understand investing don't need 50 positions. They need a handful, 6, maybe 10, of exceptional businesses they deeply understand, businesses they could explain even in their sleep. Munger once had 90% of his net worth in a single company, not because he was reckless, but because he knew the business so well he could practically predict its future. That's not risk, that's mastery. You don't need 60 random stocks you barely researched. You don't need to follow dozens of industries you don't actually understand. You need a small collection of genuinely great businesses run by competent, honest people. Companies with durable advantages, predictable earnings, and products the world will still want decades from now. 6 of those in your entire lifetime is enough to make you rich. Not 600, just 6. Buy them. Hold them. Let time do the work. That's the real path to wealth. Slow, quiet, unstoppable.
And if you're not the kind of person who wants to dig through 200-page annual reports, listen to monotone earnings calls, and analyze industry trends until your eyes go numb, then do yourself a massive favor. Just buy an index fund. Seriously, that's not quitting. That's intelligence. That's admitting you're not a full-time analyst, and you shouldn't pretend to be one. Most people would be dramatically richer if they stopped acting like undercover hedge fund managers and accepted that a simple index fund will outperform their research 90% of the time.
There's no embarrassment in choosing something that works. The only embarrassment is owning 50 random stocks you don't understand, trailing the market year after year, burning money in hidden fees, paying taxes you didn't have to pay, and convincing yourself you're learning. That's not learning. That's self-inflicted financial damage. So here's the move. If you own more than 20 individual stocks, you are massively over-diversified. Slice it down. Keep only the ones you understand at a gut level, the ones you can explain without Googling buzzwords. And if you can't describe in one clean sentence why you own something and how the company makes money, then it has no business being in your portfolio. Sell it today, not eventually, not when the market improves, today. If that leaves you with 5 stocks or none, and you end up in an index fund, congratulations. You just upgraded your entire financial life and saved yourself years of mediocre performance. Now, mistake number 5. You're bleeding money through fees and taxes like you've been stabbed and you don't even feel the wound. I get it. Fees sound boring. Expense ratios don't trend on TikTok. Nobody brags about tax loss harvesting at parties. But ignoring this stuff is one of the most expensive mistakes you will ever make.
Let me put it in numbers that should slap you awake. Say you invest $10,000 a year for 30 years. Totally normal. Scenario 1, you choose a low-cost index fund. Expense ratio, 0.04%. Basically free. You buy it, leave it alone, forget it exists. At a 10% annual return, you walk away with about $1.8 million. That's a solid, comfortable retirement built on autopilot. Scenario 2. You choose an actively managed mutual fund that charges 1% a year. Only 1%, right? Just a tiny drip. Except that tiny drip turns into a flood. After fees, your return drops to 9%. And suddenly, after the same 30 years of disciplined saving and investing, instead of $1.8 million, you've got about $1.5 million. That's a $300,000 penalty for nothing. Not extra performance, not better outcomes, not superior strategy. Just money siphoned straight out of your account into someone else's because you didn't pay attention. And most active funds don't even beat the index, so you're paying more to get less. Genius. And that's only the annual fee. That's just the cover charge at the door. Now add trading commissions from all your impulsive buys and sells. Add bid-ask spreads you don't even realize you're paying. Add the taxes, the silent killer. Every time you sell something for a profit, you trigger capital gains taxes. If you held it less than a year, you're paying up to 37%. That's not a tax, that's highway robbery. Long-term gains are still 15 to 20%, which means every time you act like a hyperactive trader, Uncle Sam is reaching into your portfolio and taking handfuls of your returns before you get to enjoy them.
Most active traders give away 30–40% of their gains to fees and taxes. Then they sit there wondering why their accounts aren't growing. But I'm up 50% this year. Wonderful! After taxes and fees, you're up maybe 30%. Congratulations! You spent a year glued to screens, stressed out of your mind, and barely beat an index fund that required zero effort and didn't even check its phone once. Warren and I spent decades avoiding this trap. We held stocks for 30, 40, even 50 years to avoid capital gains taxes. Why sell? Selling is like lighting 20% of your money on fire immediately. Then you have to hunt for another investment good enough to replace what you just lost, and that's not easy. It's stupid to sell unless you absolutely must. And Berkshire doesn't pay dividends either. You know why? Because dividends get taxed instantly before you can reinvest them. We'd rather keep that cash compounding inside the company, tax-free, like a snowball rolling downhill for decades. That's how real wealth is built, by avoiding unnecessary taxes, not by collecting income that gets shaved down by the IRS every year. But what do? You trade constantly. You panic sell winners because you're terrified they'll fall. You cling to losers because you can't admit you were wrong. Every trade is a fee. Every short-term sale is a tax bomb. Every emotional decision drains your future wealth. You're not investing. You're sabotaging yourself, one click at a time. So here's what you're going to do, and if you skip this step, you're basically choosing to stay poor. Take 10 minutes and dig into your brokerage account. Yes, actually do it. Open your 1099. Look at the sheet you always ignore because it makes you uncomfortable. Add up your capital gains taxes. Add up every trading commission you've ever shrugged off as just a few bucks. Add up the expense ratios on your mutual funds and ETFs, the tiny percentages you said didn't matter. Add it all together. If that total is more than 1% of your entire portfolio, congratulations, you're not investing. You're paying the subscription fee to lose money. You're working hard all year just to hand a chunk of your returns to Wall Street, the IRS, and whoever convinced you active trading makes you smarter. It doesn't. It makes you poorer. So cut the nonsense. Switch to low-cost index funds. Stop trading every time you get bored. Hold your investments for the long term, not for the length of a TikTok attention span. I'm not exaggerating when I say this might be the single most valuable piece of financial advice you'll ever receive. Minimizing fees and taxes isn't glamorous, but it could easily put an extra $500,000, maybe more, into your pocket over the course of your life. You just have to stop lighting money on fire. Now, mistake number 6, and this is the monster that destroys more wealth than every crash, recession, bubble, scam, and bad stock pick combined. You let your emotions run the show. This is the silent killer. This is how smart people end up broke with a shelf full of personal finance books.
Your biggest enemy has never been the stock market. It's not inflation or China or interest rates or Jerome Powell's press conferences. It's you, your brain, your impulses, your fear, your greed, your panic, your FOMO. The little voice in your head that says, do something at exactly the wrong moment. When the market tanks, you panic. When the market rockets upward, you chase. You do the exact inverse of what wealth building requires. Everyone knows buy low, sell high, but almost no one does it because emotions override logic. What people actually do is simple. They buy high when everything feels safe and euphoric, and they sell low when everything feels terrifying and uncertain. And they repeat this forever, wondering why they never get ahead. Let's look at real history. March 2020, the world shuts down. No one knows what COVID is. Markets plunge 34% in a single month, the fastest crash ever recorded. Every news channel pumping fear 24/7. People convinced society was collapsing. What did the average investor do? Dumped everything. Get me out. It's all going to zero. What did we do at Berkshire? Nothing. Absolutely nothing. In fact, we quietly bought more. Beautiful companies were suddenly 30%, 40%, 50% off. Why would we sell? It was a clearance sale. And what happened? The market fully recovered by August. By the end of the year, it hit new all-time highs. Everyone who panic sold locked in permanent losses, and then froze, terrified to buy back in as prices climbed. They missed the entire rebound, the easiest money they could have made in a decade.
Then came 2021, the opposite extreme. Markets soaring, crypto exploding, Bitcoin at 60K, Dogecoin, NFTs, meme stocks, GameStop, AMC. Everyone's a genius. Every Uber driver, every barista, every TikTok influencer suddenly giving financial advice. This time is different. New paradigm. Money printer go brr. FOMO everywhere. What did we do at Berkshire? Again, nothing. We sat on $150 billion in cash. People mocked us, said we were dinosaurs, said we don't get it, said we were missing the future. Meanwhile, retail investors were YOLOing their life savings into cartoon monkeys and companies losing millions per quarter. And what happened next? 2022, reality returned. Markets crashed, crypto imploded, Bitcoin dropped 70%, meme stocks collapsed, NFTs turned into worthless pixels. All the people who finally decided to get in at the top got obliterated. Most are still underwater today, playing to break even, refusing to admit they bought the hype and got burned. Meanwhile, we sat with our $150 billion waiting patiently, because when everyone else is breaking their necks chasing easy money, that's when the real opportunities begin to form. Here's the pattern you must learn if you ever want to escape financial mediocrity. When your gut screams, sell everything, that's usually when you should hold or buy. When you feel an overwhelming urge to buy because everyone else is making easy money, that's usually when you should sit still or sell. Your emotions aren't signals, they're traps. And if you don't learn to ignore them, they will drain your portfolio year after year until you finally blame the economy instead of the real problem, the one staring back at you in the mirror.
So here's the solution. You need to create your investing rules before your emotions take over. Not during a panic, not during a mania, not when your portfolio is tanking or skyrocketing. You need to write them down when you're calm, when your judgment is clear, when you're thinking like a rational human instead of a terrified animal. Your rules should be simple and firm. I will not sell during a market crash unless it is absolutely necessary for survival. I will not chase runaway stocks just because they're trending. I will not obsessively check my portfolio every day. I will not let fear, greed, or hype dictate my decisions. Whatever your personal rules are, spell them out. Put them on paper, stick them somewhere visible, because when the next crash hits, and it will, your emotions will scream at you to panic, and in that moment, those written rules will be your lifeline. Follow them instead of the instinct telling you to sabotage your future. Now, mistake number 7, and this one is deadly. It destroys more wealth than bad timing, bad strategies, and bad advice combined. The mistake is quitting too soon. Most people abandon the process right before it finally starts paying off. They dabble in investing for a couple of years, maybe 3, maybe 5. They don't get rich, their portfolio grows slowly, they lose patience, they convince themselves the entire system is rigged and that wealth is only for the privileged, so they quit. They go back to gambling, guessing, or hoping for miracles instead of building something real. What they don't grasp is that wealth moves like a glacier at the beginning. It crawls, it barely shifts. The first decade is painfully slow. You invest month after month, year after year. Your balance rises a little, then drops a little, then rises again, and you wonder if any of this is even worth it. After 5 years, your account looks unimpressive. After 10, still not exciting. It's frustrating and completely normal. But something remarkable happens if you stay the course. Year 15, year 20, year 25, suddenly the numbers start accelerating. Money begins to multiply on top of money, and the process transforms from slow to explosive. You're no longer earning returns on your contributions. You're earning returns on your returns, and then returns on those returns. That's compounding, exponential growth that's invisible at first and unstoppable later. The first $100,000 takes forever. It feels like dragging a boulder uphill. But the second comes faster. The third arrives even quicker. By the time you hit your 5th or 6th $100,000, those amounts might appear in a year or 2 without you doing anything different. That's the power everyone wants, but almost no one waits long enough to reach. I didn't see real wealth until my 50s. I didn't reach my first billion until my 70s. That wasn't luck. It was the result of 30, 40, even 50 years of consistent discipline. Buying great companies, holding them, reinvesting profits, ignoring fear, ignoring bubbles, letting time do the heavy lifting. Most people simply don't have the patience for that. They want shortcuts, hacks, instant success. When the slow approach doesn't give them dramatic results fast enough, they jump ship. They switch strategies again and again. Stocks, real estate, crypto, options, day trading, hoping each new approach will be the magical one.
But none of them work, not because the strategies are flawed, but because they never stay with any of them long enough for compounding to take hold. Here's the uncomfortable truth almost no one wants to acknowledge. The stock market has averaged roughly a 10% annual return for an entire century. 100 years of wars, political chaos, recessions, currency crises, market bubbles, bank failures, crashes, pandemics, inflation waves, and despite every disaster imaginable, the long-term average still hovers around 10% per year. That means one thing, and it's not up for debate. If you invest consistently and avoid catastrophic mistakes for a few decades, wealth isn't a possibility. It's a mathematical certainty. Not a guess, not a hope, a guarantee backed by historical reality.
But the real challenge isn't the math. It's surviving your own doubts. You'll be tempted, deeply tempted, to walk away. Around year 3, when the market tanks 30% and every headline screams doomsday, you'll feel like everything you saved is evaporating. In year 7, your friend will brag about turning a tiny crypto bet into 500%, and you'll feel like a fool for only being up 80%. In year 12, when progress feels painfully slow and you feel like you're stuck on an endless treadmill, you'll question why you're even doing this. And that moment, that boring, discouraging, invisible moment, is when most people quit. They give up a few inches before hitting the part where compounding explodes. They abandon the race right before the finish line appears. Don't make that mistake. Do not quit. If you've already stuck with investing for a few years, you've already endured the hard, slow, tedious part. You've built the foundation and pushed through the years where progress is almost imperceptible. Throwing in the towel now would mean wasting all that effort. But if you keep going, 10 more years, 20 more years, the rewards multiply beyond anything most people ever see. Stay the course long enough, and you will, without exaggeration, end up in the top few percent of wealth in this country. Not because you're special, not because you're lucky, simply because you didn't stop.
So here's the final, clearest advice I can offer you. Choose a strategy that is proven, boring, and durable. Index funds, dividend growth investing, value investing, a long-term ETF portfolio, anything that's been tested over decades. Then commit to it for at least 30 years. Not 3, not 5, not until the next shiny opportunity distracts you. 30, full stop. Don't quit because it's hard. Don't quit because it's dull. Don't quit because your friends are chasing quick wins and bragging about their overnight gains. Don't abandon your plan every time a new trend goes viral on TikTok or CNBC. Just keep going, keep contributing, keep reinvesting, keep pushing through crashes, euphoria, boredom, envy, fear, and market noise. That's the entire secret. That's the whole formula. Avoid the 7 deadly mistakes, stay patient, stay disciplined, and refuse to quit. You won't become rich in 5 years, probably not even in 10, but in 30,
you'll be wealthier than nearly everyone you know, without gambling, without stress, without hype, without relying on luck or timing, just by being steady, rational, and consistent. And if you're still reading, that already tells me something about you. Most people clicked away minutes ago to chase some ridiculous 5 stocks set to 100x next year nonsense. Perfect. Let them chase fantasies. Less noise for you, more opportunities for people who actually understand how wealth is built. If you want more content like this, no hype, no nonsense, no magical predictions that will age like milk, hit subscribe. Everything I share here are timeless principles that worked 50 years ago and will still be true 50 years from now. That's what this channel stands for. I'm done. Now go do the boring, disciplined things that quietly make you wealthy.